Good evening, ladies and gentlemen, and a warm welcome to our webinar titled Indian Microfinance Sector, A New Dawn. I'm Anthony Jose, Executive Director and Chief Rating Officer, Acuité Ratings and Research Limited, and your host for this evening. I'm sure most of you are aware of Acuité Ratings. However, for the benefit of those who are joining us for the first time, let me briefly introduce ourselves. Acuité Ratings and Research Limited is a full-service credit rating agency registered with Securities and Exchange Board of India (SEBI) since 2011. Acuité also received RBI accreditation as an external credit assessment institution for bank loan ratings under Basel II norms in the year 2012. Since then, Acuité has assigned almost 9,500 credit ratings to various securities, debt instruments, and bank facilities of entities spread across the country and across a wide cross-section of industries. We have our head office in Kanjur Marg, Mumbai, and other offices in New Delhi, Bangalore, Kolkata, Ahmedabad, and Hyderabad. Acuité Ratings and Research Limited has two wholly owned subsidiaries, Smira Ratings Private Limited and ESG Risk Assessments and Insights Limited. And these three entities collectively form the Acuité Group. This is the second webinar from our new Acuité Decipher series to help our audience decode industry trends. Today's webinar is focused on the Indian microfinance sector. We are joined by distinguished panelists from different segments of the industry, who will deliberate on the evolving industry landscape, various opportunities and challenges, and the way ahead for the industry participants. Before we start, I want to bring the attention of all our attendees to the Q&A box appearing in your Zoom controls panel. Please do send us all your queries in this Q&A box, and we will try to answer as many as possible towards the end of this webinar. Let me share a brief agenda for today's webinar. To start with, we will commence with a presentation by the Acuité team, followed by an interesting panel discussion with four distinguished leaders from the MFI industry, which will be moderated by our Executive Director and Chief Analytical Officer. I'll introduce them all prior to beginning the session. Post this panel discussion, we will be taking audience questions in the Q&A session before ending the webinar. Delving deeper into the subject of today's webinar, the Indian microfinance sector. Overall, the financial sector has displayed significant resilience to the pandemic challenge. The pandemic deeply disrupted the global economy over FY21 and FY22. The Indian microfinance sector was also not insulated from the pandemic. The operations in the Indian MFI sector were severely impacted during the successive lockdowns, leading to elevated stress on asset quality and subdued profitability, apart from a slowdown in the growth trajectory. The disbursement levels in FY22 recovered back to the pre-pandemic levels. Further, disbursements have also shown year-on-year growth in first half FY23. The asset quality has also witnessed a continuous improvement as reflected in the portfolio at risk or PAR. With significant pickup in disbursements, availability of adequate capital, and the recovery in asset quality, the earnings profile of the industry looks better and is expected to improve further in FY23. We now move on to an insightful presentation on the Indian microfinance sector by our team. To present this, I'll be joined by my colleague, Sumit Pramanik. Sumit Pramanik is Associate Vice President, Financial Sector Ratings, and oversees ratings of NBFCs and securitization transactions at Acuité Ratings. He has over 8 years of experience in business analytics and credit ratings. Over to you, Sumit.
Thank you so much, Tony, for the introduction. Very good afternoon to everyone present. So again, a very warm welcome to the webinar on the MFI industry, A New Dawn. I will share my presentation and then let's go through it. Okay, so I will take you through the recent developments in the MFI sector in India. We will talk about the industry story during and post the pandemic period. It's a very interesting account of how the sector is bouncing back. Now, as we all know, MFIs serve as the rural and economically underserved section's backbone. MFI lenders include banks, small finance banks, NBFC MFIs, other NBFCs, and DFIs. So let's get started on understanding the sector's development better. This is how our presentation is going to flow. First, we will look at the AUM and disbursement trends, which are thankfully on the rise. Next, we will look at the asset quality, followed by capital mobilization. After that, we will bring into focus the performances of Acuité ratings rated NBFC MFIs. And finally, we will wrap up by highlighting the major takeaways from the presentation. So going ahead with the AUM and disbursement trends at the industry level. So this graph shows the increase in the AUM over the past few years and how it stands as of Q2 FY23. Now, if we observe carefully, for the first time, NBFC MFIs have overtaken the banks in terms of portfolio outstanding as on Q2 FY23. This is a major development. The NBFC MFIs have crossed the rupees 1 lakh crore mark as far as AUM is concerned. This showcases the healthy pace at which the NBFC MFIs have been able to adapt to the post-pandemic ecosystem. Also, as on Q2 FY23, the NBFC MFIs outran the year-on-year growth rate as compared to that for the MFI industry. So while the overall sector's AUM grew by around 20.22% year-on-year, the NBFC MFI segment grew by 29.42%, which is quite significant. And this shows healthy signs for the NBFC MFI players. When talking about Acuité's predictions, Acuité foresees their portfolio growth to continue into FY24 as well, which will be propelled by higher demands in the industry. However, the banks are not lagging too far behind. After suffering a slight decline in AUM as on FY22, this segment made a quick comeback, displaying a year-on-year growth of 5.5% as on Q2 FY23. Thus, the MFI sector, after facing challenges during the COVID-19 period, has staged a turnaround. It can be safely said so. However, challenges such as the recent regulatory revisions and other issues, which we shall talk about shortly, still remain. Despite these issues, Acuité foresees the sector to post higher AUM figures in FY23 and FY24. Now let us look at the state-wise AUM distribution and how it has moved. Studying the AUM growth in the major states of the country, we notice a significant regional disparity. So rather than a pan-India trend, here we see different pockets, different regions with their different trends. States such as Bihar, UP and Jharkhand have shown very healthy growth. On the other hand, the states in the eastern and the northeastern regions have not been able to keep up their growth momentum. Specifically, West Bengal and Assam have been struggling a bit. A few of these states have even shown shrinkage in the loan portfolio outstanding. The major reasons behind their below expectation performance can be political issues, natural calamities, and the inability to recover post the pandemic. So moving forward and moving slightly closer, taking a closer look at the details of the AUM for the NBFC MFIs in particular within the whole industry, we observe that there has been a growing inclination towards managed off-balance sheet portfolio. Also, if we slightly zoom into the details of managed portfolio, we see that the proportion of assigned and bilateral agreement has been expanding. Now, this trend has appeared because the NBFC MFI players have been in recent times more comfortable in raising funds through direct assignment transactions. These direct assignment transactions provide them a hassle-free alternative to access funds. Also, the companies seem to be now more open to cooperating and coexisting, resulting in higher bilateral agreements as well. Okay, so that was our take on the AUM increase and AUM growth and how it might look going forward. Now let's move into disbursement level trend. So this graph shows us the disbursement trends over in the overall industry. We have shown the quarterly disbursement and yearly disbursement trends. The disbursements have increased, keeping pace with the rising demand after the COVID-19 period. And Acuité expects the disbursements to rise significantly during Q4 FY23 to further serve the demands that had remained unfulfilled during the pandemic period. However, the volume of loan disbursement is predicted to stabilize at around 15% for FY24. So the growth seems quite good, right, in terms of AUM and disbursement. But how well have the MFI players managed their asset quality, right? That's the big question. Now, growth is very good, but what about the asset quality? Has there been any slippages or not? We will have a look at that shortly. Okay, so here we see two graphs. The graph on the left shows the industry PAR trend, while on the right, the graph shows the NBFC MFI PAR trend. Here, one thing to be noted is that all the data points are net of write-offs. Okay, so what we observe is, though the industry has recovered to the pre-COVID times in terms of AUM and disbursements, however, the asset quality is yet to improve to the pre-pandemic levels. Okay, if we look at the graphs, you can see that the asset quality is still not as well as it was before the COVID-19 had hit. Acuité expects the GNPA to remain between 1.75 to 2.25%. However, due to adequate provisioning, the NNPA is expected to stay below 0.5%. Again, all these numbers and predictions are net of write-off. Also, another very interesting trend that is visible, if we compare these two graphs, we can see that the NBFC MFIs have displayed significantly lower 30 plus DPD as compared to the overall industry levels, which is really kudos to the NBFC MFI segment. So there, 30 plus has shown almost 40% lower numbers as compared to the overall industry. So going ahead with the asset quality geographical details, here we have shown where different states stand in terms of their 30 plus DPD. The graph shows the state-wise 30 plus DPD as of September 22. Okay. So in terms of geographical performance, there remains unevenness at the pan-India level, which we had mentioned before also. Certain states in the east and the northeast, they continue to grapple with past crises. We can see as the numbers show, Assam is the worst performing state with above industry average 30 plus DPD of 33.78%, while Karnataka stands at the best position at 1.96%. And if we look at the difference between 33.78% and 1.96%, the disparity is quite huge. Now delving a bit deeper into the state-wise asset quality. Okay, so here this table shows the asset quality movements for the past 3 quarters as well as for 2021. And so looking at the color coding, we can see that the green colored cells, they highlight the states which have performed better since last quarter. The red colored cells highlight the geographies which have performed worse than the previous quarter. And the yellow colored cells, those states have remained almost similar to what they were in the previous quarters. So we can see that while Maharashtra, Bihar, Kerala, Tamil Nadu and Karnataka have displayed improving PAR 90 plus trend, Assam, West Bengal and Punjab's asset quality they showed slight slippages in Q2 FY23 compared to the previous quarters. So yeah, there are causes of concern for these states in terms of the asset quality. The rest of the states have remained at a similar level. So now we will be moving into the operational and financial metrics for NBFC MFIs. In the next slide, we will discuss the operational and financial metrics both in these graphs. Right, so in these graphs, in all these graphs, The x-axis categorizes the performance of companies with different AUM sizes. So for example, less than 100 crore columns will cater to those entities which have less than 100 crore AUMs. So a few trends are quite visible, although these graphs, they seem to be quite showing a little bit of upside and downside. However, there seems to be some trends that are visible. For example, in the return on assets. So return on assets have been showcasing a rising trend on an overall basis. Except the 100 crore to 500 crore companies, the ROA remains 1%. So although the ROA is on the rise, it is still below 1%, except this one bucket that I just mentioned. Now, this is still a cause for concern because an ROA of less than 1% is not quite healthy. Acuité still observes some stress in the ROA department. The operating cost. So if I look at the top left corner graph, the operating cost majorly showed a rising trend in the less than 100 crore and 500 to 200 crore AUM companies. But the rise is not significant enough to cause any major concern. Okay. And finally, if we look at the cost of funding graph, we can see a stable trend. So the trend has not altered too much. The cost of funds have remained quite stable. Okay. So from cost of funds, we move into the sources of funding, right? So here we have given 3 pie charts detailing the various sources of funding since 2021. We have given one for 2021, 2022, and as of Q2 FY 2023. Now there are some very stark observable trends that are visible through these graphs. One is if we see the latest pie charts, we can see the growing diversity in the sources of funding. So what used to happen in FY21 was that there was a huge dependence on banks as the sources of funding. However, now it has diversified into various sources. There is a reducing dependency on banks as a source of funds. On the other hand, we can see an increasing portion of funding received through securitization and direct assignment transactions. So these alternate modes of raising funds are becoming more and more popular as we go ahead. Okay, so that was about the industry. So at the industry level, we looked at the AUM and disbursement growth. We saw how the MFI sector is still struggling a bit when it comes to asset quality. We looked at various operational and financial parameters also. So with that fair idea about the industry, let us now turn our attention to the performance of MFIs rated by Acuité in particular. Okay. So for this exercise, what we have done is we have taken a representative sample size of 20 companies for which the data are available for all the time periods. And we will also note that all these entities are NBFC MFIs. So these are all NBFC MFIs rated by Acuité. So this table gives us summaries of their performance for FY21 and FY22 and Acuité's projections for FY23 as well. Okay. So if we look at the top, the loan portfolio outstanding is estimated to grow significantly. Now this growth is quite significant by 40.4% in FY23 as compared to FY21, which is like a big jump from the COVID times, right? Similarly, the disbursements are also expected to grow by a whopping 56.1% in FY23 as against that in FY21. Okay, now going a bit down, let us focus on the net interest margin for a moment. So after a slight dip in FY22, the NIM should recover to 10.6% in FY23. Now, what can be the reasons, right? Acuité expects the NIMs to increase because of the following. One is because of the removal of ceiling of interest rates charged from the customers, the cost of funds not going up, and the OPEX is also set to reduce. Now, because of these reasons, the NIMs are expected to recover in FY23. Okay. So from this tabular format, we have converted some of these parameters into graphical format. Okay. And we will be talking about the expected trend, which is a study on Acuité rated clients. Acuité foresees the gearing levels. So if we look at the top left graph, the gearing levels are slotted to increase to 4.6 times as on FY23. Now, although this might seem a bit elevated, okay, as per the industry standards, this increment would be a result of strong growth in AUM and disbursement. So although this might seem slightly elevated as per the historical standards, however, there is still not too much concern for cause for concern. Going forward, the NBFC MFI's ability to raise capital at regular intervals and tame the gearing level will remain crucial as per Acuité. We also anticipate the cumulative PAT of these players to grow by 29.2% for FY23 as compared to FY22. So there's going to be a positive movement in the profitability index as well. Talking about the asset quality indicators for our clients in particular, both the GNPA and the NNPA are expected to improve slightly in FY23 as compared to FY22. And this would happen because of improving asset quality and adequate provisioning levels. All right, so that brings us to the end of the presentation. Now, before wrapping it up, I will highlight a few of the key takeaways from the presentation. As we already saw that there has been significant pickup in the AUMs and the disbursements, and we have a major prediction to make. Acuité expects industry to cross rupees 3 lakh crores mark in FY23 for the first time in history. So for the first time in history, the industry is expected to cross the 3 lakh crores mark in terms of disbursement. Although there has been a sluggish asset quality recovery, Acuité expects the GNPA to remain between 1.75% to 2.25% due to adequate provisioning. However, the NNPA is expected to remain below 0.5%. Also, we saw rising interest rates, which led to increase of funding costs till H1 FY23. The funding scenario has improved across the sectors. However, there are some smaller MFIs that we notice still face some challenges. NIMs increase we already discussed. It will happen because of ceiling removal of interest rates charged from the customers, pass-through of any increase in cost of funds, OPEX, which is set to reduce, and normalization of credit costs. We also had a look at the profitability index and saw how it is moving positively forward. It is still relatively low compared to other NBFCs. It is still relatively low compared to other NBFC sectors, but still recovery is happening, which is a positive sign. And while profitability is set to improve further with greater volumes, this sector needs to remain cautious on asset quality. So that's all from my presentation. Thank you everyone for your patient hearing. Thanks a lot. Over to you, Tony.
Thank you so much, Sumit. That was indeed a very insightful presentation. I'm taking away 2-3 things. One, how a new high that the industry will now see with 3 lakh crores, the improvement in NIMs, and of course the change in funding profile of the sourcing mix for the sector. Let us now begin with the panel discussion. Today's panel is graced by the presence of 4 industry experts who bring in immense knowledge of the Indian microfinance market and lead their respective organizations. It is my pleasure to introduce them. To begin with, our first panelist is Mr. Gaurav Gupta, Managing Director, Ananya Finance for Inclusive Growth Private Limited. Mr. Gupta has been with Ananya since 2014 and has made significant contributions to the company's turnaround by raising capital, diversifying into new lines of business, and turning the company profitable. He leads the company's transition from wholesale to retail and digital transformation. He is a qualified chartered accountant with experience in banking and financial services. Welcome to the webinar, Mr. Gupta. Mr. Kuldeep Maiti, MD and CEO of VFS Capital, is our next panelist. Mr. Maiti is associated with various microfinance institutions in India, such as Sadhan, Amphi West Bengal, and MFIs. He is a founder member of Amphi West Bengal and is on the board of Sadhan. He is a dedicated social worker and has been working for over 2 decades for the poor to bring cheer into their lives and a smile to their lips. He has received numerous awards for his work, We welcome you, Mr. Mighty. The next panelist is Mr. L.V. Murthy, CEO, Dwara Kshetriya Grameen Financial Services Private Limited. Mr. Murthy has a diverse experience of over 29 years spanning the domains of sales, channel distribution, strategy, microfinance, financial inclusion, remittances, customer protection, and capacity building for remote rural markets. Prior to Dwara, he headed operations and financial inclusion business for Sahaj e-Village, the largest service center agency operating 28,000 common service centers across 6 states. He also worked for India Value Fund Advisor Private Limited, Bharti AXA, ITC IBD, Tata AIG Life, and Indian Express newspaper in the past. He has engaged and spearheaded initiatives using IT as a differentiator in terms of delivering and servicing financial products at affordable pricing. Welcome to our webinar, Mr. Murthy. Our last panelist is Mr. Vikas Jain, Director and Chartered Accountant by qualification, who has been associated with AKA Capital Group in the Indian debt market for more than 20 years. His current role includes leading the advisory business for private sector companies, including mid-market companies, some of them being MFIs, for their debt resources. Additionally, Mr. Vikas Jain is leading the alternate asset vertical of AKA Capital Group. Mr. Suman Chaudhary, Executive Director and Chief Analytical Officer, Acuité, will moderate the panel discussion. With an aggregate experience of over 26 years in credit ratings, research and risk, he has worked in leadership roles in credit rating agencies and a private sector bank in India. Over to you, Suman.
Thank you, Anthony, for the nice introductions. Good afternoon, everyone. It's really a pleasure to moderate a discussion on a sector which has such significance for the transformation of the Indian economy, and that too with the esteemed industry leaders that we have today. So welcome Mr. Murthy, Mr. Mighty, Gaurav, and Vikas to this panel discussion. Thank you for coming and gracing the occasion. Personally, I had the privilege of watching the microfinance sector closely over the last 2 decades. And it's virtually like, like seeing an infant growing up to become a teenager and going towards adulthood. It has seen these growth pains, gone through crises, as you are aware, notably the Andhra crisis in late 2010, October 2010, if I remember right, where a significant part of the portfolio of microfinance in that state had to be written off. So from those times, and as we stand today, the AUM of the overall industry, as Sumit pointed out, and this doesn't include self-help group. We are talking about joint liability business. It stands at around 3 lakh crores with over 6 crore borrowers. NBFC MFI, among them, they account for more than 1 lakh crore now. And this after going through what is clearly and undoubtedly the worst crisis that microfinance sector can possibly have in the form of a deadly 2-year pandemic. 90-day DPD or NPAs, if you say, at this point, reported NPAs as on September stands at 2.3% after write-off, of course. And for NBFC MFI, it is even lower at 1.4%. And we haven't seen too many defaults, in fact, very few defaults in this sector. This, in my opinion, conclusively testifies to the resilience that this microfinance sector has built over these years. So with that introduction, let me start the panel discussion by asking the first question to Mr. Murthy. Welcome, Mr. Murthy. What's your outlook for the near-term growth in NBFC MFIs? And do you think the current environment is conducive for a rapid growth in the portfolio, let's say particularly in the southern states?
No, thanks, Mr. Suman. Thank you, Anthony, and thank you, Acuité, for organizing this webinar. Really appreciate. Pleasure being here, and welcome everyone. I think in terms of the prospects that you asked, the prospects look very, the outlook looks very positive, and I think 2 years of subdued growth thanks to COVID is where, again, industry is coming back to growth. And in terms of southern states, as a specific question that you asked, I think from a development perspective, you look at it, southern states had always been having a higher AUM, higher disbursements when compared to other states. I think the trend will continue. I think the fear of unknown, thanks to COVID, that actually set in, is kind of going out. And I think people have become resilient in terms of how to handle crisis is something which one has learned. And if you look at it in the last 4 to 5 years, starting from 2017, when every crisis has taught the industry in terms of how do we become resilient, how do we become more innovative. And you look at it starting from AP crisis that we had, followed by demon, down south. If you look at it, say for example, Tamil Nadu, one of the bigger states in terms of AUM and disbursement, you had a big natural disaster in terms of Gaja cyclone that came and hit, and then the financial tsunami, and then the financial crisis in terms of IL&FS, DHFL, and all this stuff, and COVID. I think people have started to realize that once in 2 to 3 years there would be some crisis or the other than the regular drought or cyclones that affect each of these geographies. So people, keeping that in mind, I think people have also started looking in terms of how do they kind of plan for their personal growth, their business growth, and their whatever money that they are actually borrowing, and how do they invest. And I think that we should thank the entire industry for and spreading the awareness in terms of the credit culture and how do you utilize this money. The various checks that you do as part of the loan utilization check, and also the various communication, soft communication that goes to the customers in terms of ensuring their credit worthiness is something which has actually helped. Obviously, there's a lot that could be done. In the last 2 years, things have changed. Every day is a new day. The new normal gets defined every passing day. But I think from a growth perspective, as what we see in urban India, we talk about revenge spending. I think same thing is coming into rural India also, that people were kind of keeping quiet for about 2 years. They were very cautious. Whatever little surplus that they had, they were just holding on to it. And again, they are back to investments, back to setting up new initiatives, setting up new investments. So from that perspective, I see future to be growing further.
Great. I think it's very encouraging to hear that there is a kind of a maturity coming in the market among borrowers, and which is going to be positive for the further development and risk management in the sector. I will come next to Mr. Maiti. Mr. Maiti, the microfinance portfolio in the East and Northeast, as we alluded in the presentation, this has been impacted not only due to COVID, but also because we know of a past few crises, including cyclones, etc. Do you see microfinance growth coming back to these regions in the near term, or this stress is going to take time to heal?
Yeah, very good afternoon. So I think because we are one of the oldest entity in the eastern part, so we know the political sense and the other things what is happening in the eastern part. I think I don't know why, but always for everything East is blamed. I mean, that's always I am able to see. Okay, East means there is a political risk. East means X, Y, Z, whatever. I mean that kind of mindset it is having. But if you see the portfolio quality, West Bengal was always having the best portfolio quality. And and we are in the sector from 94, 95 in the microfinance domain. We never had more than, 1% gross NPA. Never ever had. Not only it's about VFS, I'm talking about the other practitioner also. So I think East is always, they always have a better kind of repayment history. And the other way also, if you see, like East people, they are very conservative. Though it sounds very regional, but I can tell you, like in Bengal, Assam, wherever, if they need 20,000, they will ask for 20,000 only. But when I am talking for the other states, because we are presently based in 14 states, so there if they need 20,000, they will ask for 30,000, 35,000. So I think utilization of credit is always better in Eastern.
Okay.
Due to this long lockdown, Amphan, then there is political things happen in Assam. I think this is a very temporary phase we are passing through, and I am very hopeful because whenever we are talking to the OD customers, actually they have started paying it. They may not able to pay the entire amount what was there as default, but most of the customers, they have started paying it. It may take a little bit of time, but it will come back to the normal track before, just like pre-COVID situation very soon. I'm very extremely hopeful.
Great. I think that's again encouraging, because there, as you said, that maybe in some of the among the lenders, there is this perception that there is a kind of an asset quality issue in certain parts. But I think the borrowers, once they are aware and they are keen to repay their debt, I think definitely the situation will turn positive in some time. I will turn to Gaurav. Gaurav, my question will be on the smaller MFIs and their growth visibility after the post-COVID scenario. How are they going to grow? Are they getting enough funding, or is it going to be mainly through off-balance sheet mechanisms, like maybe a BC model or even assignments? How do you think the smaller MFIs are coping or planning to grow in the next phase?
Right. Thanks, Aman. Yeah, so see, certainly, it's a known fact that the smaller MFIs were obviously hit the hardest after the pandemic. The PAR increased for all MFIs, irrespective of size. Liquidity, again, thanks to government schemes and RBI, TLTRO and government, guarantee-backed funding schemes. Some of that percolated down to MFIs. Again, thanks to the efforts of the SROs also. So that has kept the smaller players also in good stead. But one big difference between the larger players, tier 1, tier 2, and let's say tier 3 MFIs, or even tier 2 for that matter, is that they've struggled to raise equity gap. So as we know, beyond a point, unless you're able to raise equity, how do you grow your finance business at the end of the day? Right. So what we have seen, an interesting trend is that the smaller players have been able to attract partnerships in BC as BCs. So earlier we had, maybe pre-COVID, just a handful of banks that were doing BC partnerships. But today we have banks, we have small finance banks, we have NBFCs, and NBFCs of all sizes. Even a company like us, which is such a small NBFC, we have 16 partnerships. And incidentally, out of 16, 7 are in Bengal. So I completely allude to what Kuldeep sir was saying, that we also believe it's temporary phenomenon in Bengal and will kind of bounce back. But that aside, I think BC is picking up. The other thing about BC is that what we are seeing is that the larger players, especially banks, they are kind of comfortable with much higher AUM to net worth ratios, which is helping the smaller players. So where the RBI has capped the leverage ratio at 7x, which is again on the higher side. Typically anything beyond 5x becomes quite risky for balance sheets. Here we have seen players going up to 10x, 12x, 15x also. Now, while there is risk, what we are seeing is that the banks and other large NBFCs are willing to take that risk simply because these practitioners might be small, but they have been around for quite some time, maybe a decade or more. So they know the business, they know the geography, they know how to do the business. One. Second is almost all players today, the level of automation is reasonably high. So API integration with bureaus, all that is already in place. Plus the exposure that these principals are taking is actually, these are large balance sheets. So the exposure they're taking per originator is actually on the lower side. So we've seen practitioners, appointing even not-for-profits as their VCs, actually. Very, very small entities as their VCs. So I think growth is coming from there for now. Sure.
Correct. Yeah, absolutely. I think our presentation also, Gaurav, highlighted this trend where we are seeing, a larger proportion of non-bank funding sources, which is primarily what we are saying, and what Sumit alluded to is that the proportion of direct assignment, securitization of balance sheet funding, VC. So those kind of funding sources have really improved or risen significantly over the last 2 years. So this is what we believe is a very meaningful diversification of the funding profile of the NBFC MFIs and much lesser dependence on the banks. Now, my question is to Vikas. Vikas, on the funding side, do you believe that this trend is going to gather momentum, that MFIs will not be so much dependent anymore on banks, and they will have much better access to maybe NCDs or other funding sources, maybe other NBFCs, securitization?
So thanks, Sumit. Thanks, Anthony and Sumit, and to the panelists. Thanks for the invite. But yes, Sumit, I think you've touched the right point, right? What has happened is that we've seen that trend increasing. Now, obviously, we at AK Capital predominantly focus on the debt capital market. We have our own NBFC also, and largely what has happened, and there's a lot of experiences also coming in from our own lending perspective, is that the lenders, right, will need to be adequately rewarded for the risk perception. Now, the entire debt market, we clearly need to understand that if the risk is priced appropriately, now appropriately is always a vast word, right? But largely, if it is attractive enough, right, it does attract capital market investors. Correct. Now, what has happened? I think a lot of combination has happened, and I think Murthy sir touch based on this part, that there is a maturity which has happened in the MFI industry, right? So what will a lender look at, right? The lender will typically look at, the industry has gone through various cycles and is matured enough, right, to absorb any such kind of adversity. That gives the first comfort to a debt lender, correct? Second is he getting an attractive yield, right, on the exposure that he's going to take. So, Suman, what has happened is there's a good confluence that we've seen happening, right? That because the interest rates generally rose, right? So, repo moved up by 225 basis point, banks have moved up by 125 basis point. Suddenly, there is a yield attraction, correct, also coming into play, right? Which is, and we considering the equity market position as of now, we see a lot of non-institutional pull in very recent NCD issuances that we did. Just to highlight, in fact, we were able to do the maiden NCD issue through the public issue format for the large, the credit access Grameen, which was right. It was the maiden from the industry and maiden for the company, and which
the first ever in the MFI sector public.
Yes, the first ever public issue of NCD from the MFI sector.
Right.
So that attracted 65% non-institutional money. Correct. Now, this is where, as you rightly said, I think the question about the MFIs, right, tapping the capital market, that trend is definitely increasing. To answer your question, but yes, there will always be some sectors who will kind of some within the MFI segment, there will be some who will possibly tap for the public issue. Some will be more on the private placement, and those will be the guys who will be vacating, right, the bank funding basically for the mid and the smaller size BFS, MFI.
Correct. It's a function of, the ratings and the size, all those factors are also relevant.
Correct.
Right. True.
So, that's very clearly an increasing trend. In fact, just to put a number to a perspective, in fact, it's only 9 months. What we believe is almost 2,300 crores have been raised to the NCD market by the MFI sector in the private placement, and so that trend is increasing.
Right.
And we continue to see this attraction mainly because our own house view is that interest rates largely will remain elevated through this calendar year. That's the expectation that we feel is there, and that will keep that attractiveness of fixed income. And MFI ticks boxes everything, right? It's an asset class which is a 24 to 36 months. It's a monthly collection. Some will have a weekly and a fortnightly collections. You've seen those worst case Blackstone events, right? And industries come out largely unscratched, right? And obviously the monitorable is the ROI and the asset quality number, which I think that's where the larger investor monitorable is still there. But we see this trend clearly increase.
Sure. Great. I think that's a very good perspective on the emerging trends on the funding side. I will again move to Mr. Murthy. In terms of, I think I will just kind of tweak this question a little bit. In the microfinance sector, you also see a certain level of operational risks. There can be frauds. There are employee frauds that we have seen. There are a lot of operational challenges that one sees, which also results in challenges. How can technology be used or is being used to address some of this operational risk?
Yeah, I think every crisis moves you to a new way of doing business. This is what I said earlier. And if you look at it, Demon taught us how do we become digital in terms of disbursements. One leg of the value chain completely got digitized. What COVID taught us is in terms of moving towards digital collection. And one of the bigger frauds that you usually come across into this business is pocketing of money, collected from customers. I think still a long way to go, but I think moving towards digitization, I think the external environment also, ecosystem has also moved towards digital, that it is actually helping us to educate the customer in terms of shifting towards digital collection. Now, when there is already an identifier which is given to a customer in the form of Aadhaar, and how do you use Aadhaar as a primary unique identifier and ensure that the collections become digital. Digital is the secondary part. I think frauds we always look at fraud in terms of money being collected, but I think frauds can be prevented if we do the inputs properly, and those inputs are which also getting digitized starting from customer onboarding process. The eKYC processes, the ghost lending that we earlier used to have a problem of ghost lending and the customer not being there. I think the entire eKYC process itself is something where digitization is helping us in terms of actually doing validation of various identities in terms of be it voter identification or whatever the multiple institutions giving API connects to basically to authentication is helping in terms of onboarding customers who have valid KYCs. So that itself is a big relief for the industry. Having said that, I think the entire due diligence process of a customer has also further digitized. You look at it, the lifestyles are changing. One size fits all is slowly shifting, that you basically group loan is a pre-underwritten product, that it is a very compartmentalized kind of a thing that you are actually putting that particular customer into a kind of you format the customer as per the product. But slowly, I think customer aspirations are changing. The customers are wanting a higher ticket loan, wanting individual loans, and that is where individual loans are moving to more cash flow based underwriting, which further actually helps you to understand the customer in the customer's household, that you are the whatever frauds that could have happened in terms of figuring it out, those things. The utilization of the loan for the purpose of what has been the loan taken has also, many ways has been digitized. Say, for example, a classic example that if I could give cattle. Now, typically in rural India, dairy is the economic driver, and people take loans to buy cattle. And at least at our end, Dwara KGFS, we are tied up with our sister concern, where identification of cattle can be done through, the muzzle of the cattle is a unique thing for every cattle. And how do you use the latest AI and ML tools to basically identify a particular cattle? So that really helps in terms of reducing fraud. The third, obviously, is renewals. Good paying customers, how do you basically ensure that can I push them into a seamless digital onboarding and all that stuff? So various digital initiatives have actually helped in terms of customer sourcing, customer servicing, and customer collect, the entire disbursement and the collection part. While doing that, I think what has happened is that this has led to an end-to-end digital fulfillment capabilities that the institutions have built. The huge amount of data that you sit with, where you could actually slice and dice a customer and a household, is also helping you in terms of reducing frauds. Having said that, I think customer awareness has also gone up. That when we collect money, we immediately send voice-based messages or all that stuff. That what is the amount that has been collected, what is the receipt that has been issued. We educate the customer that if you have collected money, please ensure that a receipt is given. Okay. That is one. The second thing is the entire employment onboarding process that you got to check. The industry has got a huge attrition rate, and if you as an institution are not doing proper due diligence of the employees whom you are onboarding, obviously that is the first entry back thing that you could actually look at it. And how do you ensure that prospective employer has got no background of doing any fraud? So
I believe I had heard this, Mr. Murthy, that there is a suggestion that you should have a negative list of employees who have been involved in frauds, so it helps the next employer.
Absolutely. And I think another thing is that all the video KYCs, video calling, and doing due diligence through WhatsApp video calls when you are actually underwriting a customer to figure out as to is it really there or that one. The entire geotagging of a customer's household, geotagging of a center, geotagging of a group, all that leads to control in terms of frauds.
True. I just had one related question here, Mr. Murthy, on this technology side or collection side. Now, what I understand is disbursements. I was going through an MFIN report which said that a lot of disbursements now have become cashless, but collections is still a little bit of a challenge. Now, one doubt I had is now we are all talking about UPI volumes, right? We all know what volume of UPI transaction is happening. Government is talking about it. And I'm sure people in rural areas also have access to a smartphone and they have UPI. So even then, is it so difficult to have collections digitally?
See, it is not difficult to do collections digitally. I think it is more in terms of customers' behavioral aspects. See, today, what was said and done from a customer's ecosystem, especially in rural India, most of the customers either work on a daily wage basis or, their salaries basically are more from a cash oriented. The DBT schemes and all that stuff have become digitized that, they go and get credited into the customer savings account. And customer today has become, as I said, matured and smart that they keep that money as something which could be investment or a saving, and their regular, whatever the cash in happens and the household is what goes as a cash out in terms of payment. But slowly customers are also realizing the importance of digital. Today what has happened is, over a period of time, I think everybody has become very enterprising in nature, that either they have started working or they are doing something. They don't have that much of time to come and sit, wait, or go to the branch and pay cash. They are also seeing the benefit of, saving time and paying digitally.
Absolutely. Okay. Great. Thank you. So, Mr. Maiti, I think you mentioned that things are gradually going back to normal, especially in eastern part of the country, and we all know that there was a time when market, the portfolio was very stable for a long time there. Now that it has been in some form of a crisis, which we believe is temporary, there has been some dispensation which was provided by the RBI on restructuring during the COVID period. What's the assessment, and not just East, in general on the sector, on the restructured loans? What kind of recovery is expected? Do we expect kind of a significant recovery from these restructured loans, or there can be a risk of further write-offs?
No, I think most of the restructured loan, it will come back, because what I believe, once the customer started paying it, so that customer will close that loan maybe 2 months, 3 months. They may take extra time, but money will come back. So I don't think there'll be any kind of significant negative impact in terms of NPA, but overall, I think total maybe whatever you have estimated, around 2% maybe the NPA may happen, and which is normal, which is absolutely under control.
Right. Especially when we have seen back-to-back crises, so I think some losses have to be naturally taken.
Right. And I believe that whoever has done this restructuring, from MFI point of view, I think it is not, there is two things. One is evergreening and one is restructuring. So, it is not a evergreening thing that, okay, this NPA customer, so I am giving additional loan or restructuring it so that it can be taken care of the par and provision. It's not like that. Restructuring, most of the MFI is done on the basis of the future, the present activity and future cash flow of the particular customer, and customer wants that time, and that's why once the customer is agreed to repay, once the customers has started the activity, then only restructured happened. And in most of the cases, collection is coming, almost perfectly all right.
Okay, that's good to hear. I will go to Gaurav again. Gaurav, I think what we see, if you see the growth, particularly in some of the states like northern states, Bihar or UP, it is growing much more than the other states. The growth is much stronger. The ticket size also is going up. So is multiple lending was one identified risk in the sector earlier, excessive leverage or excessive debt. Do you think that's still a very important risk? Is something that the industry should be cautious about?
Yeah, honestly, it's not restricted to UP and Bihar alone. We have today our own branch network in our subsidiary Prayas Finance, and in the various 16 odd BC partnerships, we have roughly about 70 odd branches across 10 states. The rejection rate at our end today, in the first check, which is being rejected by the system, is nearly 70% even today. Now, earlier, pre-COVID, rejection primarily used to be because of credit history. Today, the primary reason for rejection is actually what we're seeing is that there are two reasons. Of course, we are doing a manual intervention, and we are the rejection rate is still coming down, but still it is higher 40-45%. And the single biggest reason for rejection is multiple lending. So what we are seeing is that when RBI removed this change the regulation and earlier only 200 should give a loan. Now that has been removed, and though it's become a level playing field, the household income has to be assessed, the household indebtedness for just cap 50%, etc. While all these regulations obviously heading in the right direction is what we believe. It will take some time for this to kind of percolate, settle down. Take some time for the entire household income data to the bureaus, and then for this the regulation to actually take effect. It is up to the practitioner, it is up to the MFI to kind of decide. For example, we have what we have done is that as a policy, in case the outstanding for a particular household is greater than 50 rupees, it's an outright reject. We don't even get it because it is difficult to assess accurately the household income and household indebtedness. It is it becomes just one second. So it becomes it is up to the practitioner to actually take a call, put in place proper systems and processes to assess the household income, the household indebtedness.
That becomes a key factor, the right assessment of.
It becomes a key factor. I mean, earlier, Mr. Murthy highlighted almost all the points related to, what are the mitigants or steps being taken by MFIs to, reduce the operational risk. So, one of the key factors is client selection. So, I think, in future, this will be a key factor which will determine how well the portfolio is performing for the MFI.
Right. Great. I will again move to Vikas. Vikas, I think a little you talked about the debt market side, and you represent that part of the market. There is a emergence, what we believe, and not just limited to just investing in MFI instruments, but a new class of investors we see in the Indian debt market who are digitally savvy, who are not averse to investing in high yield papers, and they are comfortable with, let's say, bond platforms, where we are seeing that we are seeing a lot of online platforms, right? I think that's happening. So do you think this is something of another trend, and this is going to be an important source of funds for NBFC MFIs also?
Yeah, Sumit. So I think largely what we firmly believe is pandemic, I think for all of us, right? Pre-pandemic and post-pandemic, the business rewriting has happened across industry, right? And that's when we possibly realized the India and the Bharat story, right? And digitalization was the only way kind of where we could kind of reach out to a larger segment, right? Of whatever our clientele is. For MFI, it is their customers. For a debt market player, it is the investor who's sitting out in a tier 2, tier 3 city who doesn't have right now that part. And so when I think you picked up the right point. And this new young generation, which is emerging as an investor class, are willing to take that high risk. The family offices are willing to take high risk.
Right.
The third part which is happening is there is a larger allocation to the fixed income space. Everything cannot just be an equity or a real estate, right? That's been a larger realization, which is happening. Now, kudos to SEBI. Here, I will take an opportunity to say, I think, highlight that SEBI has done a wonderful job, right? So, online platforms like the digital lending guidelines, which recently came in, SEBI has formalized the online bond platforms. They want to be registered as a stockbroker. Now, what does it mean? It means that it has given them the legal sanctity and the regulatory clarity, right? Which as a platform was required, right? For example, AK logo. I mean, we have our India bonds as
right.
online bond platform. Now, what it did was that it gave that legal sanctity to the entire platform. Correct. Now, today, typically an application form, correct, takes only 2 minutes, right, for it to be filled. Exactly 2 minutes, right, to be filled. It'll fetch the KYC, the application is done, settlement done through the UPI, correct. And we don't need to go and have a very large branch, right? So to answer your question, in the recent public issues, right, that we happened, right, we do a lot of public issues, including the we saw this component substantially increasing. The contribution of online bond platforms, right, and there are a lot of debt market players who promoted the online bond platforms. We see this contribution coming in a big way, right? That's increasing purely because of the convenience, right, and the settlement being through the UPI.
Yeah.
So, that's actually started happening, and Suman, I would not be surprised, right, that non-institutional market, right, typically largely will come in through the online bond platforms, right, rather than the traditional route. And what we also, again, one more data point which was important, again, recently when we were doing a webinar, right, for again a public issue through the online bond platform, India Bonds. See, there the participation was almost more than 1,000 people.
Oh.
Correct. Now, a similar pre-pandemic in a roadshow, typically we generally saw a participation 70 to 100 people per roadshow. Correct.
Right.
That itself shows, right, that the ease and the convenience, right, of the online bond platforms, right, are increasingly part, and they offer stock in the secondary market, right? So we clearly see the trend happening from the non-institutional side.
Right.
Institutional, you have the stock exchange EBP platforms, right, which are the platforms. They will tend to go there. But these online bond platforms will typically be useful for the non-institutional.
Correct. So what it will do is, if I can use the term retailization, it will kind of enhance the retailization of the market. It will, because it's easier to access, and maybe the ticket size also can be smaller, and you can also have HNIs, and you can also have retail individuals participating in this market.
So one more point is, in fact, from 1st of January 2023, again SEBI, kudos to SEBI, they've reduced the face value for a listed entity to 1 lakh rupees.
Okay.
Right.
Okay.
Now, the public issue market has always seen that ticket size to be around a 3-4 lakh rupee, right? So it's largely, I mean, the size is fairly attractive, right? From 1 lakh. Earlier, it used to be like a 10 lakh.
Right.
Correct. So yeah. So I think the stage is set, and yields are attractive, right? And we see that to be a little more extended period of time. So we will possibly see a lot of the non-institutional demand across. So MFI will obviously be also benefiting across with all the other NBFCs.
Correct.
Yes, there is definitely a yield play around there.
Correct. And especially as you said that the supply, if I can say the supply of papers, or rather the demand and supply, it will be matching better, because there are, as you said, there are individuals, let's say, who are not getting enough yields from the fixed deposits, or they're willing to take a little more risk, and they're looking for higher fixed income yields. And this can be a wonderful platform for that.
Correct.
Right. Great. I think we have done 2 rounds of questions. Should we, Tony, should we spend more time on the panel discussion, or should we go to questions and answers? I think we still have a little bit of time. So we will maybe ask a little small question to all of you, and then we can go to the Q&A. One question I had to Mr. Murthy on capital. I think our presentation highlighted that, as growth is coming back, obviously more borrowings are required, and this will increase the leverage. So our projected leverage levels in the sector are increasing, which means that there will be a need to raise capital, if not immediately, in the near future. So what do you think is the accessibility of capital at this point in time?
I think, see, during the COVID time, if you look at it, as you also mentioned in terms of presentation, and you did speak about it, I think all the existing investors did put money to create a level of confidence, one to the company and one to other institutions, saying that yes, we are there to support the organization when the organization needs it. Having said that, I think it was to create that level of confidence that the initial equity raise happened internally for most of the institutions. And as the growth is coming, obviously, today, I wouldn't even go to equity. First step is, raising debt. I think raising debt has become far more easier in this financial year, and especially in the last quarter, where, banks and every other institutions have opened their doors. And with the industry growing, obviously, people who invest in the form of equity would definitely be attracted to this particular MFI and the NBFC line of business. So I personally don't feel, and we at Dwara KGFS, I think we are not too worried in terms of our inability to raise capital. I think capital is abundantly available. It is purely in form of whom do you choose and when is the right time to actually invest.
Right. The quality of investors and their perspectives are also very relevant for.
See, as long as the capital adequacy levels are comfortable and your leverage is comfortable, you can continue. And I think if it is exceeding or going beyond a threshold level is where you need to worry. But I think with the existing growth, obviously, everybody would definitely want to get into markets, raise equity, and be as leveraged as possible. But I don't see that to be an area of concern.
Right. Mr. Maiti, a related question on this part is that, there are institutions, financial institutions like, for example, SIDBI, NABARD, SIDBI in particular, who had been providing long-term, may not be in some cases equity, but in some cases subordinated debt. We have seen MFIs who have issued sub-debt to these financial institutions. So long-term funds were available. Do you think that is still available from institutions, or is long-term funding, like equity funding, it is still difficult to get?
I think tier 2 capital is a little difficult to get at present, but as the other panelists said, that now I think most of the investors, they are interested to invest in the microfinance sector because of the recent RBI policy, because they have given a lot of space to play for the MFIs. I think they have deregulated the interest rate, a lot of things. I mean, the non-qualifying asset parts. So I think these are the things where the investor are getting more interest. And these kind of crises, they also know these are very temporary thing. And I think microfinance is one of the sector where even banks are getting 100% repayment from the MFIs. So I think there is a very limited chance of cash loss. So that way equity is readily available, but as you said, that it's all about buyer and seller decisions.
True. Right.
I think I just want to add one more. Sorry,
please.
No,
go ahead, please.
As Mr. Kuldeep rightly said, I think with the new microfinance guidelines, that have come, this industry has become pretty attractive. And why has it become pretty attractive is, I think there's a lot of scope for innovation now that can happen, especially with cap on pricing getting removed. The one size fits all doesn't really working. Cap in terms of FOIR, where you're supposed to look at it. So I think a lot of innovation, a lot of use of digital tools and all that stuff. I think now it is moving to the next level where earlier it was just, group lending and all that stuff. Now I think innovation in terms of product design, innovation in terms of distribution, all this is actually making the industry and pretty attractive place to be in. So I don't see any reason why equity investors shouldn't look at to this investing into this particular sector.
Right. Here, I just wanted to, squeeze in a related question, Mr. Murthy, on since this point you raised, is, even in the past, we had heard about this thing of cross-selling. So what about cross-selling of other products and services to the MFI borrowers? Now, is that something that is still workable, or is it what technology can help to do?
Yes, of course. We strongly, as an institution, we believe in terms of that. You are creating a channel, you are creating an asset for yourself in terms of customer onboarding, and how do you leverage that asset, and how do you leverage that particular household. There is a genuine demand in terms of other products, and we kind of believe in ourselves as a holistic financial service provider. So, in terms of be it in terms of protection, be it in terms of savings, whatever best that we could do. How do you actually give? And there's a huge appetite for other products which are basically wealth management products for this set of customers, because there is no formal way to get this kind of products, and cross-sell and upsell using latest AI and ML tools, using digital technology. I think cost of distribution will come down drastically, and that is the reason why one should look up to it and start doing cross-sell and upsell to the customers.
Correct. So, there was this idea about insurance also being one of those products, right? Is that something that makes sense, or it's too complex for that distribution?
I think that thing is complex as long as your ability to communicate is in the language and which is easy to understand by the customer. And how do you build processes to ensure that there is no wrong thing that happens?
True. Gaurav, my one question was that we also see that many NBFCs, when we are looking at that funding, that there are many NBFCs, smaller NBFCs, who are accessing funds from not banks only, but from other larger NBFCs, which may not be MFIs, but they can be any kind of category of NBFCs. So kind of, wholesale lending coming from other NBFCs to MFIs. Is that also something that you believe is a trend?
Yeah, see, there are 2-3 things that are happening in the industry. One is that, as part of treasury management, you have some players who've been active wholesale lenders. These are large NBFCs, they are growing. They are comfortable in the sector per se. So they are lending money to MFIs, both for building an on-book as well as an off-book by way of VC or holding. They are also doing a lot of securitization transactions with these MFIs. Right? So that is one. Second thing is that the other opportunity, I would allude to what Mr. Murthy and Mr. B said on equity. The sector certainly has become attractive because with the RBI relaxing the pricing. Now MFIs have margins to actually spend on both the geographical expansion and technology. Right. So in fact, as I told you that our partners, most of our partners are in Bengal. I mean, large number of partners are in Bengal, but the branches are also. These are small partners, and they have chosen to diversify, invest in locations which are outside their home state.
Right.
So on the cross-sell point, on insurance, already life and medical insurance cost is being sold. When it is sold, it's a pretty standard offering along with the loan. We are seeing our partners actually even trying to get into inventory insurance or some other insurance products that are required and which will help mitigate risk for the borrowers' clients, essentially. It's a well-known fact that many MFIs actually cross-selling on other products, solar products are cross-sold.
Okay.
So, from an equity perspective, I think it will depend on how the MFI is able to kind of innovate, diversify its product base, grow through partnerships and with a diversified growth profile as well, given the opportunities, including smaller players. Though it will be difficult, there is a strong bias towards size, and it's like a chicken and egg story. Equity comes, then you grow. Until you grow, equity doesn't come. So it's like that.
Got it.
But yeah, I think the sector should now become more attractive to investors. There is a lot of liquidity. larger NBFCs are, I think, sensing this as an opportunity and are willing to take risks with smaller players.
Absolutely. Right. Good points. I think you mentioned. Last question to Vikas. I think we have already discussed this about bond platforms, but just this trading, one of the issues in the Indian bond market is you don't have any depth because there is hardly much of secondary market trading. Do you think these platforms that this can actually facilitate trading of, let's say, MFI papers? Is that something that happens, or we hope it will happen in due course?
So I think the secondary market, more obviously, these platforms definitely will be enablers, right? Because there is a ease of convenience, right, in terms of transacting through these platforms. But eventually, there has to be an investor demand.
Right.
Now, the hard fact, Suman, has been that domestic institutional in the debt market has been more conservative than offshore investors, right? So largely, how I look at it is that non-institutional investors, right, for companies with good governance, right, are still very open, right, to take those kind of risk, because obviously it comes in, their money gets priced, right, to the risk, right, that they will be taking. So largely the point is it is more investor driven. The online platforms definitely are enablers, correct? And what I see is that the larger ones, the larger MFIs, right, will more move towards the capital market, right?
Right. You will see more public issues also?
Yeah, so definitely the public issue, obviously, the very large ones, right, will typically look at, because so generally what happens is, we, at least at AK, one philosophy is definitely there, that retail are one investors that they lose money one day, right, and they just they go off the market for a very long period, right? So largely what has happened is that more who are listed peers, right, typically will look towards tapping the public debt market, largely, right, because they are listed, they are
already
more eyes, right, and a lot more operationally controlled, right, from that part. The mid-size segment, the A category, because the mutual funds definitely is vacated this space. So it's a huge space that they've vacated, which is like the A category, right? And I see the AIF filling in that part, correct? So the very large ones will be more on private placement, the public issue. The mid-size segment, which is the A category kind of rating, is where the AIF will typically.
Okay.
Correct. And the smaller ones, right, will still, very frankly, for some more period, will need to be more on the banking segment and the securitization market.
Right.
This is how I see the kind of dotted line largely mapping in across, right, the way it typically happens. And what happens is, the more the large guys, right, shift towards the capital market, what eventually they're doing is they're vacating space, right, in terms of limit, right, for the mid and the smaller size, right? So this, in any case, for the MFI industry is a good trend, right? So the large ones move out, right, they start tapping the market and they vacate space in the banking segment, right, for the mid and the smaller ones. So to answer your question, I think SEBI's also been worried about the secondary market. Unfortunately, right, we still don't have that kind of depth in the secondary market. We've seen that happening at least till the A category rating, right? That kind of demand, and largely from a non-institutional pull factor, that still is there. But yes, we still have to travel a long route, right? And the online bond platforms will definitely be an enabler, because they give them the non-institutional one the ease of convenience of the.
Sure. I think online blind platforms and the use of these platforms hopefully will help us to develop the bond market further in India. And with this, I think we will conclude the formal our panel discussion. And I will hand it over back to Tony for the Q&A session.
Thank you, Suman. I'd like to take this opportunity to thank all our distinguished panelists for their valuable insights and perspectives on the Indian microfinance sector. It was actually a pleasure to look at things from their perspective, each one of them at their grassroots levels, in some of the comments that they made. Thank you, Suman, for making this an interesting discussion. We'll now take a few questions from the audience in the Q&A session. We received an overwhelming number of questions in the chat box and some also over email. I would request Suman to pick some of these and enrich today's webinar.
Yeah, let me just refer to what we have. A few, one or two has come in my messages. Just one question that I have here is there a case for having a bank-sponsored MFI to tide over capital constraints and increase credit delivery to the lower strata of society? Banks should be allowed to lend to MFI segment only through this MFI. In this way, they can be made part of the information sharing arrangement. Okay. I think would anyone would attempt a response to this? I guess what they're trying. Yes, please, Gaurav.
I think if I heard you correct, I think the question is that banks kind of they sponsor an MFI and then get into the microfinance space.
Correct. So basically, the bank is the owner of the MFI, and therefore there is no constraint of capital, and they kind of are able to grow the portfolio in a very strong way. I guess that's the idea.
Right. So yeah. So see, banks already have a nearly 38% share of the AUM, and we are seeing consolidation happening in the industry with banks acquiring actually large MFIs. Right. Plus, banks are appointing increasingly. Now we also, earlier, as I said before COVID, we had only a handful of private sector banks entering VC partnerships. Today, we are seeing more banks. In fact, a few of the large PSU banks are becoming quite aggressive on the co-lending front also with MFIs, including smaller MFIs. So I think banks are already
yes.
Either through direct microfinance or by acquiring MFIs or by having tie-ups where they are able to control the operations, product design, client selection, their own tech platform, etc.
Absolutely, and you mentioned about VC models, and many banks have VC arrangements with some of the MFIs. I think banks are already, and just to add to what you already said, banks are already there. I think Sumit also mentioned that in the overall industry, banks already have a significant presence. We have the example of, like in the East, we all know about Bandhan Bank in particular, which was itself a microfinance institution and then became a bank. So they're pretty big. So I don't think there is any such need to have any separate ownership. And secondly, what I understand is that regulators are not comfortable of having a business bank doing a separate lending business outside the bank's balance sheet. They want all the lending business to be part of the bank. So I think it's whatever is at the current arrangement, that's good enough. I think getting all the right support, both funding and operational support from the banks.
Plus, we have small finance banks.
Yes, absolutely. Small finance banks also.
They are also right.
Yes, true. Let me just check the chat box. Are there any questions that we have here? Yes. Just going through. I think one question that we have seen is fundamentally about how our industry, the microfinance in India, how does it compare or compared to other parts? Are we in terms of penetration, is it comparable with what's there, let's say, in some other parts of Asia, or we do have to go a long way? Are we already very developed? in terms of microfinance, or we are lagging behind? Basically, a comparison with the global landscape, if that is something somebody can contribute.
So a few thoughts on that. It's okay. I mean, actually, globally, it varies from geography to geography. For example, in South Asia still has the largest percentage of, I think, poor people, and actually the pandemic has pushed. I mean, whatever good work was done by microfinance and other sectors. I mean, the pandemic has pushed us back by 4-5 years. I think the only other region that is actually poorer than South Asia is Sub-Saharan Africa. So,
okay.
So, from whatever little I know, and it's largely thanks to our major shareholder that is invested in multiple countries. So,
Okay.
It is essentially, it varies. So, there are markets that are far more advanced than us. There are markets where the penetration, the coverage of the people in microfinance is very, very high. I mean, a market like Cambodia is like heavily penetrated.
Cambodia. Okay.
Yeah, for lending, etc. There's too many MFIs per borrower, let us say. So, specifically in regard to India, I mean, as it was presented in the report, we have roughly about 6 crore, unique borrowers. Even but I think the SRO reports also clearly highlighted, there is still a long way to go simply because of the sheer size of our country.
Of the demographics, yeah.
Percentage of population that continues to be unbanked. And thanks to COVID, the population actually has gone down below poverty levels, or the $2, $3.5 per day earning of as quoted by World Bank as the threshold which the household needs to be catered to, needs to have access to finance to be able to improve their household income. So I think technologically we are there fairly advanced. The market is mature, but we still have a long way to go in terms of covering clients. Still, I mean, 90%, nearly 90% of the AUM is restricted to 300 districts. So even from that perspective, I think there's a long way to go.
Right, right. And even Bangladesh, I think we all know about the history of microfinance and Grameen Bank, the role of Bangladesh. But how is, Mr. Mighty, you have some perspective on how Bangladesh is doing currently in the microfinance sector?
I think to add with Gaurav, so I'll say India is quite mature in terms of microfinance. I think so. We are one of the most regulated microfinance here. So, and even in India, we have not-for-profit entity who are doing microfinance, the cooperatives, NGO, trust, NBFCs, NBFC MFIs, SFBs, Universal Bank. I think they have a different model, and we all are with the recent regulation. I think we are all regulated by RBI. And in terms of interest rate also, I think one of the most effective rate India offers in terms of microfinance. Bangladesh scenario is absolutely different. If you see, they're allowed to take savings. So they are not that much regulated like what we do. They don't have the pro systems what we are having. I think most of the Bangladesh MFIs, they are free to grow.
Okay. The regulatory framework is different. It's different.
There are advantage and disadvantage, both are available. So I think as because they are allowed to take savings, I think that the cost of fund is very low, and that help them to lend on a better rate. To offer the better rate of interest to the borrowers. Even they can have a social security in terms of any natural calamities happen. So they have a different kind of mechanism, and yes, but I mean every country has their own perspective. I think Bangladesh is also doing well, and we as in India also one of the best country where the microfinance is growing very fast.
Absolutely.
Suman, I would just like to add.
Sure.
The trinity of JAM, which is Jan Dhan, Aadhaar, Mobile, and convergence of this with the credit bureaus through API networks is something which is not heard of anywhere else. I think from a technology perspective, from digital adoption perspective, it is just not the institutions. I think from a customer's perspective also, considering the demographic profile of our country, I think whatever little that I have spoken to, little bit of whatever that I have read, I think from that perspective, we are little ahead of the curve is what my personal belief is.
Right, and technology is playing a key role in that.
Absolutely, I think UPI platform is one which actually, be it in terms of smartphone, or if a customer doesn't have a smartphone, you could probably pay through Aadhaar Pay, and all that stuff is something pretty unique.
Great. I think that should conclude our panel discussion. I hope all of you have really benefited from the discussion and the inputs from our esteemed experts. I will now hand it over to Anthony for the concluding remarks.
Thanks, Suman. With that, we conclude our Q&A session. On behalf of the entire management team, our leaders, and all of us at Acuité Group, let me take this opportunity to thank all our panelists, Mr. Gaurav Gupta, Mr. Kuldeep Maiti, Mr. Murthy, and Mr. Vikas Jain for taking out their precious time and enlightening our audience with some great perspectives on the Indian microfinance sector. I also thank our moderator, Suman Chaudhary, for making panel discussion an exciting one and taking audience questions. Above all, I thank all our attendees and hope that you gain some valuable insights from this webinar. The full recording of this webinar will be available on our YouTube channel, Acuité Group, for you to share with your colleagues and industry network. Follow us on our LinkedIn handle for updates and insights on the current market trends. We also request you to visit our website, www.acuité.in, for more information about Acuité Ratings and Research. We also publish regular research and opinion reports on various macroeconomic indicators, which includes our monthly commentary, Acuité Macro Pulse. Thank you once again for being with us. Have a great evening ahead. Bye.
Thank you again. Thank you so much.
Thank you. Thanks, everyone. Bye.